When a Wall Street bank doubles a forecast, not revises it upward by 10%, not raises guidance modestly, doubles it. That is not a routine model update. Morgan Stanley just doubled its humanoid robot shipment forecast for China, and the word they used was commercialization, not research, not development. Commercialization. That is a specific word with a specific meaning. So the question you need to sit with for the next 12 minutes is this. What does it actually take for a technology to cross from laboratory promise into economic reality at scale? And is China doing it right now? Let's start with the mechanics of what a forecast revision like this actually means, because the financial media tends to treat analyst upgrades as noise, and sometimes they are. But doubling a shipment forecast is categorically different from a price target bump. When an institution like Morgan Stanley revises a physical unit shipment number upward by 100%, the underlying model has changed, not the sentiment. Shipment forecasts are built on supply chain data, manufacturing capacity conversations, order book signals, and customer adoption timelines. You don't double that number because you woke up optimistic. You double it because the inputs changed materially. The specific word in the headline is equally important: commercialization. In technology analysis, commercialization has a precise meaning. It means the product has cleared the valley between prototype and repeatable economic deployment. It means someone is buying these machines not to study them, but to operate them in a production environment where the math has to work. Contrast that with where humanoid robotics was even 18 months ago. Largely a demonstration technology, impressive at trade shows, unproven at the unit economics level, that actually drives purchasing decisions. If Morgan Stanley's revised forecast reflects genuine order signals rather than speculative enthusiasm, that is a qualitatively different data point than anything the robotics sector has produced in several years. The actionable insight here is this. When you see a forecast revision of this magnitude from a credible institution on a physical world metric, not an addressable market estimate, not a revenue projection, but units shipped, start asking who the buyers are and what the payback period looks like. That is where the real investment thesis lives. This is not financial advice, but that question will tell you more than the headline ever will. Now let's talk about something that Western coverage of this story tends to gloss over, because it requires understanding manufacturing economics rather than just AI capability curves. China's advantage in humanoid robotics is not primarily about artificial intelligence research. It is about what economists call vertical integration at scale, and in this specific technology that matters more than most people realize. A humanoid robot is not a software product. It is a mechanical system with hundreds of precision components: actuators, sensors, gearboxes, custom silicon, battery systems, structural materials. The cost and speed at which you can iterate on that physical stack is almost entirely determined by your proximity to the supply chain that produces those components. China has spent 2 decades building the densest concentration of precision manufacturing capacity on the planet. That is not geopolitical commentary. It is an industrial fact that shows up in lead times, component costs, and iteration cycles. When a robotics company in Shenzhen needs a custom gearbox variant for a new limb design, the supplier conversation happens in days, not quarters. That compression of the hardware iteration loop is the single most underappreciated factor in why commercialization might be accelerating there faster than equivalent efforts elsewhere. There's also a demand-side factor that rarely gets examined properly. China faces a well-documented demographic contraction, a shrinking working-age population against a manufacturing economy that cannot simply offshore its labor needs the way Western economies did. Humanoid robots are not a futuristic luxury in that context. They are an economic necessity with a clear deployment target. When supply chain depth meets genuine demand urgency, you get the conditions that accelerate technology adoption from years to months. The actionable insight. When evaluating any robotics investment thesis, the question is not just who builds the best AI. It is who controls the physical production stack. Those are often very different answers. Here's where we need to be rigorous, because this is exactly the type of story that has burned investors before. Robotics has been a decade-long series of premature investment cycles. The market bets on the vision, the technology delivers slower than expected, capital flows out, the sector consolidates, and then the actual wave arrives and catches most people underexposed. Understanding which stage you are in matters enormously. The Morgan Stanley forecast revision is a signal worth taking seriously, but it needs to be weighed against other data points that are in the headlines right now for important reasons. Micron just reported earnings where a tenfold profit surge is apparently not enough to prevent a stock decline. Read that sentence carefully. A company posts 10 times the profit, and the stock may still fall. That tells you something critical about the current market environment. Expectations are so front-loaded on AI-adjacent hardware that even extraordinary results can be priced in before they arrive. The Korea market saw a 10% rout, followed by a rebound, as focus returned to earnings. These are not unrelated stories. They are all symptoms of the same dynamic. Capital is moving fast, sentiment is volatile, and the gap between narrative and fundamentals is wide enough to be dangerous. Cerebra's just went public and watched its stock fall after its first earnings report. That is a reminder that IPO timing and business fundamentals are separate conversations. So, how do you think about China humanoid robots in this environment without either dismissing a genuine structural shift or overexposing yourself to hype? The framework is straightforward. Watch unit shipment data, not revenue projections. Track customer categories. Industrial versus consumer deployment tells you about economic viability. Monitor iteration cycles on the hardware side, and distinguish between companies that are shipping product into paying customers versus companies that are shipping product into their own demonstration environments. The difference between those two things is the difference between a real business and a very expensive science project. Again, this is analysis, not financial advice. Your specific situation requires your own due diligence. We opened with a simple question. What does it actually take for a technology to cross from promise into economic reality? The answer, based on everything we just walked through, is this: supply chain control, genuine demand urgency, and unit economics that work without subsidies. China may be assembling all three simultaneously. The follow-up question this raises, and what we will cover next: which publicly traded companies outside China have legitimate exposure to this supply chain shift, and which ones are simply wearing the label? Subscribe so you don't miss it.